Welcome to a presentation of Hughes Federal Credit Union's Buying a Home, your guide to making a wise financial decision. My name is Elsa Jackledge, and I am the lead business development representative here at Hughes. We will start this presentation with a helpful handout. Are you ready to buy a home? Take time to complete the quiz. You will find the answers on the back. This handout will determine if you're ready to buy a home. Seminar objectives. Are you ready? How much can you afford? Get pre-qualified and/or pre-approved. Decide on the kind of home to buy. Shop for a home. Make an offer. Get a home inspection. Apply for a mortgage loan. Get homeowners insurance. And close on your home. Step 1. Are you ready? Many people harbor secret fears about buying a home, and some of those fears are justified. Not everybody is cut out to own a home, and if you're one of those people, it's better to find out now than when you're under contract. But how can you be sure you're ready? Here are 3 key points to consider. Do you have a steady job? Are you planning on staying for a while in one location, or do you like to move often? How is your credit? Order a free credit report. Give yourself time to clean up a credit report that contains mistakes. Be sure to dispute errors. Try to reduce your monthly debt obligations now by paying down those loan balances. Do not open new lines of credit or close old lines of credit. These steps will work to your favor. Do you have money for a down payment? The more you put down, the lower your monthly mortgage payment. There are many ways to get a down payment, the primary way being your own credit union account. Your chosen loan program may specify the minimum down payment, but you can always pay more. The higher the down payment, the smaller your monthly mortgage payment will be, and the bigger your equity position will be. Other questions to consider. There are many other questions to ask yourself before you take this big step. First, it's important to look at renting versus buying. Renting tends to give you more freedom to move, but you never build up equity. Equity is the difference between the market value of your home and the amount you still owe on your mortgage. Second, if you're planning to get married soon, it's important to talk to your significant other about it before you buy a home. Are you planning on starting a family in the near future? Third, ask yourself if you plan to stay at the same job or remain in the same city. If you're the kind of person who likes to move and change jobs every couple of years, owning a home may not be right for you. But if you like your job and community, then now might be a great time to buy. Step 2, how much can you afford? A standard rule for lenders is that your monthly housing payment should not take up more than 28% of your income before taxes. That payment includes the principal, interest, taxes, and insurance, or PITI. This debt-to-income ratio is called the housing ratio or front-end ratio. Before a lender offers a mortgage loan to an individual, he or she will want to make sure the person makes enough money to pay the mortgage and other expenses easily. The lender will measure the person's income before taxes against housing expenses to find out how much risk is involved. Most lenders will not approve a loan if the number is higher than 28%, but exceptions may be made if the individual applies with a co-borrower or has an exceptional credit rate. Step 2, how much can you afford? We have an online activity here, and you can go out to the link here to NerdWallet and calculate your debt-to-income ratio. If your debt-to-income ratio is 28% or lower, you're ready to talk to a mortgage broker. If it's higher, you should see what you can do to lower your expenses and bring that ratio down. Debt may need to be paid, or you may need to look for a less expensive home. Step 2, how much can you afford? If you'd like to see how much house you can currently afford, use this online tool. You can also see how much of a down payment you'll need to afford a certain house you're looking at. Get pre-qualified, pre-approved. When you have your finances in order, it's time to meet with your local credit union or mortgage broker to begin discussing how much of a mortgage you qualify for. There are 2 steps. Pre-qualify. Getting pre-qualified for a mortgage is generally fairly simple. You supply the lender with your overall financial picture, including your debt, income, and assets. After evaluating this information, a lender can tell you how much of a mortgage loan you qualify for. Pre-qualification usually does not have a cost involved. Loan pre-qualification does not include an analysis of your credit report or an in-depth look at your ability to purchase a home. Since it's based only on the information you provide to the lender, your pre-qualified amount is not a sure thing. It's just the amount for which you might expect to be approved. Being a pre-qualified buyer doesn't carry the same weight as being a pre-approved buyer. Pre-approved. Getting pre-approved is the next step. You'll complete an official mortgage application and usually pay an application fee. Then supply the lender with the necessary documentation to perform an extensive check of your financial background and current credit rating. The lender can tell you the specific mortgage amount for which you are approved. You'll also have a better idea of the interest rate you'll be charged on the loan, and in some cases, you might be able to lock in a specific rate. Here's some terminology: seller's market and buyer's market. A seller's market is when few houses are available for sale, which then drives up demand. In this situation, sellers can ask for higher prices. In a buyer's market, there are a lot of houses for sale, but fewer buyers. Buyers can take their time looking at as many houses as they want and offer bids that are lower than the asking price. Step 4. Decide on the kind of home to buy. The first question to ask yourself is, where do I want to live? Narrow your search to the key neighborhoods you like. Keep in mind, you may need to expand your search based on what's affordable for the area, but it helps to have a starting point. If you have children, check the available school options in the area. What qualities do you need in a home, and what qualities would be nice to have? Be sure to have a good idea of what you're looking for in a new home and prioritize those options accordingly. There are many choices, from townhomes and condominiums to single-family or multifamily homes, so be sure you conduct a thorough search. You may not be able to get everything on your wish list, but knowing what your requirements are before you get started will make your search easier. Few people find the perfect home within their budget, so before you go house hunting, brainstorm a list of what you absolutely must have in a home and which features are simply nice extras. Step 5. Shop for a home. Don't prejudge homes. Be sure to go inside before ruling the home out. Have your real estate agent get current MLS reports. MLS is multiple listing service. Some agents like to tour houses on their own each week and may have already seen homes that meet your needs. They may also know of homes that aren't even listed yet. Use your financial and need parameters. Narrow your search to the homes that fit your specifications. Use your pre-qualify or pre-approved mortgage amounts. Consider all available homes in your range, including fixer-uppers, REOs, which are real estate owned, foreclosures, short sales, and even homes above your price point but have a higher DOM. DOM stands for days on the market. Observe open house etiquette. If you go to an open house on your own, tell the hosting agent that you're working with a real estate agent. Step 5. Shop for a home. This is a handout which contains the home tour checklist. This will help you compare 4 different homes. It reminds you of the specific details you should be looking for and will help you evaluate the homes you viewed. Now I'll turn it over to my business development coworker to continue with the seminar.
Thank you, Elsa. I'm Irlanda Cuevas, a business development representative here at Hughes, and I'll be presenting the rest of the seminar. Step 6, make an offer. When you found a home that meets your criteria, it's time to make an intelligent and informed offer. To do so, your realtor should provide you with the list of comparable homes in the area that have sold in the last few months. This will tell you if the home is overpriced, underpriced, or just right. Consider the type of market you're in. Is it a seller's market or buyer's market when you write your offer? For instance, don't try a lowball strategy in a seller's market. You'll lose the house to a buyer making a higher offer. Choose an offer based on the amount you feel a seller will accept or counter. Base this offer on the comparable sales and input from your real estate agent. Don't shy away from a great house with multiple offers on it. Somebody has to win. Why can't it be you? If your offer is rejected, ask your agent to explain why. Step 6, continue making an offer, and these are some examples of contingencies. A contingent offer is pretty standard. It means an offer on a home has been made and the seller has accepted it, but the sale is contingent upon certain criteria that must be met. These criterias or contingencies typically fall under three major categories: mortgage approval, home inspection, and appraisal. These contingencies are mainly put in place so you, the buyer, can back out of the sale if something goes wrong, usually without losing your deposit. A seller might look at other offers in the interim, but won't deal with any other buyers until it's clear a contingency wasn't met and you back out of the deal. Chances are good that your first offer will be countered, so it's important to know how to negotiate counteroffers. It doesn't mean that you've offended the seller or that your agent did anything wrong. Some sellers simply make a counteroffer because they like to have the last word. In fact, expect the seller to issue a counteroffer. Even if you offered the list price, the seller might want to negotiate other points in the offer. If the seller counters at full price, continue to negotiate. Even if you offered less initially, you might find the continued negotiations could result in the final price that is acceptable to both of you. The first counter is not always the last. During negotiation, share personal information about your family to give the seller a reason to care about you. You'll want to put your best foot forward and have your offer resonate with the seller at a personal level. Step 7, get a home inspection. Once your offer has been accepted, you'll need to get the home inspected. It will probably be one of your contingencies in the offer. In most states, the purchase contract gives the buyer a certain number of days to conduct the inspection, which can include the home inspection as well as pest, chimney, and sewer inspections. If you uncover a major defect that you cannot accept, you are often free to cancel the contract. Hire a reputable home inspector. Not every state requires inspectors to possess any licensing or credentials, but be sure to hire a good one. Bring a home inspection checklist with you. You'll want to make sure every area of concern has been inspected and your questions addressed. Attend the home inspection, but let the inspector do his or her job before asking questions. Most will supply you with a detailed report when they're finished. Hiring a professional home inspector is recommended, but it's also important for you to know what things you should look for as well. This inspection will tell you if the home is going to need major repairs. Remember, if something is really bad and the seller will not fix it or share the cost of repairs, in most cases, you can walk away from the offer. For now, let's assume everything checks out great so we can move on to step 8. Step 8, apply for a mortgage loan. If you got pre-approved for your mortgage, this step will be straightforward. However, choosing the right type of mortgage is key in the home buying process. A fixed rate mortgage is a loan in which the interest rate on the note will remain the same throughout the entire term. Generally, fixed rate mortgages come in 10, 15, or 30-year terms and are the most popular mortgage type. Over 90% of home mortgages in the US are fixed rate. Then there's an ARM, or an adjustable rate mortgage. After the initial fixed period, the rate will change and adjust on the specified schedule. Considered riskier than the fixed rate mortgage, an ARM payment can fluctuate significantly. The benefit to taking such a risk is an initial rate that is lower than the 30-year fixed rate. A 1-year ARM is a 30-year loan in which your monthly payment and the rate itself may change every year on the loan anniversary date. Your local credit union is a great place to get a home mortgage. Here are 3 reasons why. Reason number 1, you could save money. Unlike banks, credit unions are nonprofits which don't have investors or stockholders. Instead, they use their earnings to offer members lower fees, better rates, and free ATMs. Reason number 2, you're not just a number. You'll be sure who your servicer is and may know your mortgage loan officer personally. And reason number 3, they'll even consider loaning to people with lower credit scores. Credit unions are more likely to help lower to middle class households get a mortgage. Step 9, get homeowners insurance. Your home will be the largest financial investment, so you'll want to protect it. It's important to buy the right level of homeowners insurance, so if there is a loss, you'll get reimbursed for as close to a full value as possible. Here are the most common types you'll find. There's hazard insurance. All mortgages lenders require homeowners to get a base level of hazard or homeowners insurance, also known as HOI. This base level usually covers property damage from fire, wind, hail, theft, or other similar damages. Then there's personal property insurance. You'll also want to protect the personal property in the house. Most standard lender insurance do not include personal property, yet makes up much of the value in your home. Then there's liability insurance. Most standard policies cover personal liability for injuries to others that happen on your property. For example, if you're going to own a pool, make sure you have enough liability to cover an incident. Here are some factors that affect the cost of your home insurance. Number 1, geographic loss experience. If an insurance company has lost money in your location. 2, type of construction. 3, type of fire protection and proximity, professional versus volunteer fire departments. 4, house size and condition. 5, type of contents. 6, your credit score. 7, type of policy. 8, size of deductible. 9, the company you choose, so make sure to shop around or bundle with your auto insurance to save. And number 10, your security system. And step 10, close on your home. The closing is the day when the seller receives the check and you, the buyer, receives the deed to the property. Generally, this is also the day you get the keys to your new home. At least 3 days before the closing, both you and the seller should receive a copy of the closing disclosure, which states the final terms of the loan. It tells the seller how much money they will pay or receive at closing and tells you how much money you need to close. Compare this with your original loan estimate. Now is the time to resolve problems. If the closing disclosure doesn't match your original loan estimate, ask your agent or lender why. 1 or 2 days before closing, do a final walkthrough inspection of the home with your agent and make sure the house is in the same condition it was at the time the offer was made or if the repairs you require before closing were made. Get a cashier's check for your down payment and closing costs, and make sure to call the utility company and arrange to have the utilities transferred to your name by the closing date. Meet with the lender or title company to sign the mortgage papers. Be sure to give yourself enough time to read all the documents and ask many questions as you need to be sure to understand the terms of the loan. You will be signing many binding contracts, so it's important that you understand what you're signing. The most common documents include the closing disclosure. This form discloses final terms of the loan and is completed by the escrow agent or title agent. It's an itemized list of all the services provided and the fees charged to both you and the seller. The mortgage note. This is your promise to repay the lender according to the agreed terms. The mortgage is a document used to secure the mortgage note. It recognizes your ownership of the property, but gives the lender the right to claim the property if you fail to meet the terms of the note. The affidavit, these can vary and attest to certain information in writing. The deed is a legal document conveying title to the property from seller to buyer. Title insurance is a policy that protects against any title defects such as liens or other claims against the property. Title abstract is a summary of the public records that relate to ownership of the property. Survey of property, this contains boundaries of the property and all structures are important features of the property. And finally, the escrow analysis. This provides detailed information on your escrow account. An escrow account is an account set up by your lender to pay certain property-related expenses, such as property taxes and insurance premiums on your behalf. We've covered a lot of this topic in a relatively short period of time. Our goal today is for this seminar to give you the tools and information you need to help you buy a home, as well as to help you develop a personalized plan based on your needs, your credit situation, and your wants. Please visit our website for mortgage information at hughesfcu.org/mortgages or visit hughesfcu.org financial guide for more information on preparing your finances for home purchases. This last slide has our mortgage department contact information, and you can contact any of our mortgage representatives at your convenience and when you're ready to purchase a home. Thank you so much for your time today. It's been a pleasure presenting to you.